Pace Morby just bought this.
Hey everybody, welcome to our 160 unit seller finance deal that the Sub 2 fund just acquired. I'm here with my partners, my friends.
Now, do you want to buy multifamily real estate? Do you want to invest or even wholesale multifamily real estate? I'm going to react to Pace Morby's video and teach you how you can get started. You've probably heard of Subject 2, you've probably heard of seller finance, and you've probably heard of Pace Morby. So you know about investing in wholesaling residential real estate. But what about apartment buildings? That's where the real money is at. You could be investing and making millions or wholesaling these deals and making over six figures, more than $100,000 assignment fees. But what do you look for? How do you negotiate the terms? How do you underwrite it? What do? Do you put it under contract? Do you dispo? Do you JV? I'm gonna teach you all that while reacting to Pace Morby's video right now.
Why is this even a good opportunity?
Well, you know, Pace, I mean, you could literally just turn around and look. So this was a seller that owned it. He built it, right? He built it in the 80s, owned it all the way through when we bought it.
Wow, that's like 50 years.
Yeah, I mean, he owned it forever.
So the first thing you're going to find is a lot of multifamily apartments. They're not just owned by big hedge funds, BlackRock. A lot of these apartments are just owned by regular people, you and me, but just older people. And they're retiring. They've owned these assets for decades and they are looking to retire. And what is the best offer you can give to someone when they're retiring? Hey, I'll buy your property, but let's do seller financing. Seller financing is so popular in multifamily real estate, especially with older investors who own these assets and they want to sell, but they don't want the huge tax consequence. So you could come in with a strong seller financing offer. And I bet you that's what they did.
He was doing well, right? Didn't do much because it was throwing off some money. He was happy, but he was really missing the market because we looked at it and we said, okay, well, these rents, they're a good $300-400 below market.
Whoa. So this is really good information right here. When you're looking for these deals, something you want to look for is value add. You want to find properties where you can go in and add value. So what does that mean? What does it mean to add value? That means you want to get the rents up. You want to get the occupancy up. You want to make the building nicer to get the rents and occupancy up. So you got to spend a little bit of money, but then you can increase the value. You get the net operating income, the profit up. And when you do that, not only are you making more money, the asset itself, the multifamily building, becomes worth more. So you're making more profit and you're making more equity.
What we need to do is we're a value add fund. So we looked, it's brown. Brown in 2020s is
Outdated.
It's outdated, right? So
it's not easy to go to your residents and say, hey guys, I know this guy owned this for 50 years and didn't improve anything, but welcome to the new world. Rents are higher. We're not going to renovate. We're not going to do anything. We're just going to add rents. We can't do that, right?
And you're going to see that a lot. A lot of these older men or women who own these multifamily properties, oftentimes they haven't raised rents in a while. They haven't caught up with the huge rent increases we've seen these past few years. So you can go in there and immediately increase rents. But like Pace Morby's saying, it's a little... it's not the nicest thing to go up to your tenants and be like, hey, I just bought this property and I'm increasing rents 20%. They're going to hate you. So sometimes you got to do something in return. I bet you Pace is going to paint this property gray or white. It's going to go in, fix up the inside of the property. But immediately you can increase rent. And when you can increase rent in multifamily, it's not like residential where your property is just worth what it's worth based off of the comparables, right? When you comp residential property, you're comping. Like this house I'm in right now is worth $500,000 because my neighbor's house that's very similar is also worth $500,000. And the neighbor down the street, his house is smaller and it's worth $400,000. And the neighbor way down the street, his house is $600,000, but it's bigger. And then you take the averages, you're comparing it to other properties. But in multifamily, you're not doing that. It's based like a business. You're saying, hey, this property makes this much money, then it's worth this much. And if you can increase the amount of money that that property is making, you're going to be making more money. But again, the value of your asset, the value of the multifamily is also going to go up, right?
The deal is Ryan has a great relationship with the broker. Broker says, hey, the seller's open. Ryan hits them up for seller finance. They were about to contract with us and they went a different route.
That's right.
Instead of Ryan being upset about it and, groveling about it, Ryan said, hey, congratulations. If they don't perform, let us know. We're here. Guess what? They didn't perform. Ryan was there to save the day. We got under contract. What was our purchase price on this deal?
So this was an off-market lead, and he got it through a broker, and the broker gave it to him, and that's a pocket listing. So you should really get some good relationships with commercial brokers if you want to find good deals. But another thing that's so interesting that he says in this, and that's something I want y'all to take away, is that he put an offer in and it wasn't accepted. They went with another offer, but then they came back around when that last offer didn't perform. What does that mean? In commercial real estate, it's really common for you to submit a deal, they say no, and a few months later, you circle back and they say yes. Because a lot of these buyers, they get into these properties and something's wrong with them, their due diligence period, and they couldn't get their loans, they couldn't get the money. Stuff falls through all the time in multifamily, more so than residential. So just because your offer wasn't accepted today, does not mean it won't get accepted in 30 days, 60 days, or 90 days. So always follow up. The money is in the follow up. Our man Ryan here, he is the follow up king. Good for him.
So we got into contract. It was whisper price, right? Brokers have a anticipation of value.
Okay.
It's called their whisper at 20 million. So I came in 19.5, and that's what works for our fund, right? That's the value I set at it. So came in.
So they went pretty much up to the seller's full asking price, 19.5, 20 million. It's the same thing. I know 500,000 sounds like a lot, but it's pretty much the same thing. And that's something Pace Morby and the creative community does a lot. Hey, I can come up to your price if you can give me really good terms.
What did the seller want as a down payment?
So the seller wanted, basically he had some small debt in place. So we had to take care of that. That was like a 10, 15% of the purchase price.
Okay.
All right. He also wanted a little bit of extra skin in the game from us, right? So this is a 35% down.
Okay,
right?
And 15% of it was basically paying off an old debt. The seller says, look, I've got an old remaining loan. Probably at some point he refinanced, pulled some cash out.
Exactly.
So he still has that debt, and he goes, hey, I'm okay seller financing $15 million to you or whatever it is, but I'm not okay seller financing and letting you do sub 2 to my old debt. It would just make me feel better if you pay off the old debt, and I'll seller finance the whole thing, basically a lot of it too.
Exactly.
Okay, so that was a lot of information there, so let me just quickly break it down for you. This is not a hybrid transaction. This is a straight seller financing transaction. And the seller had a few $1,000,000 of debt on the property. He had like $4 to $6 million in debt. And instead of taking over those debt payments, which, you know, Pace Morby, he's the sub 2 king, the seller didn't want to do that. And in this case scenario, you couldn't assume the debt. Assumptions in multifamily, it's very common. So if you're calling a property and they're like, hey, no, we got debt on the property, say, hey, you know, can I assume that debt? Say, if they can't, be like, hey, you know, do you mind if I take over those debt payments? If they're not interested in that, well, then maybe then you have to pay it off. So they had to bring like $4 or $5 million to the table just to pay off the debt. And then they had to give the seller cash on top. So they're in this one 35% down, which on 20 million, quick math is like what, $7 million down? That's a lot of money down. A good rule of thumb for you is to try to keep the down payment under 20%. So if you can find a deal with under 20% down payment in multifamily, that's great. That's great. You know, Pace stepped up and did 35% down. So if you're going to do a bigger down payment, the property better be making you a lot of money. And I'm sure he got really good terms because, you know, Pace knows what he's doing. But just try to keep the down payment under 20%, or if possible, you know, not over 30%. Not over 30%. Just a good rule of thumb.
3 different strategies. One would be, let's improve the property, which means improve the value.
Right.
Go to a bank, do a refinance, pull our investors' capital out, potentially keep the asset. Another asset or another strategy would be, hey, let's improve value and sell this and roll our investors into the next deal. Have we determined what that strategy is going to be yet, or we're still kind of figuring out what the market will be when we decide to make an exit?
So with multifamily, it's a little bit different than residential. Multifamily, you get a lot more flippers, but they're not the traditional fix and flippers where they go in a house and in 90 days they fix it up and sell it. You have long-term flippers. Think of them almost like swing traders. You know, in the stock market, people do day trading where they're just trading stocks every second, but you get other type of traders who buy a stock and will hold on to it for a few months and then sell, or maybe even a year or so. That's more like what multifamily is. So Pace is showing 2 different types of way to swing trade this property. There's really 3 exit strategies. It's either you hold a property, You fix it up and you refinance. You take out your equity, you get a new loan, you get some cash, and you still own the property, but you're just stripping out the cash. So a property like this, when you increase the value of the property by rehabbing it, by increasing the rents, by increasing the occupancy and getting that NOI up, the property is worth more. And when it's worth more, you can either refinance, where you pull cash out of the property and you keep the property, or you can just sell the property and make a huge amount of money by selling it. You're increasing the value over the next few years, maybe 3 years, maybe 5 years, and then you either refinance or you sell it. That's usually the exit strategies for these investors. So yeah, oftentimes in multifamily, these people are either going to refinance or sell the property, usually within 5 or 7 years. But there are some investors who will just buy a property and hold it for the rest of their life. And those options are dependent on many things. That's for a different video. It depends on the interest rate of this deal, depends if you negotiate a balloon. It depends on a lot of factors. But just know, in multifamily, it's really common for people to buy a property, make it better, increase the rents, increase the profitability, and then sell it over the next few years. That's a very common exit strategy. Now let's talk about rehab.
The value add is going to cost $3 million just for the value.
Whoa! Just rehabbing this property is going to cost $3 million. $3 million. So they're bringing $7 million down to pay off the loan and give the seller some cash. And then they need to bring another $3 million just to fix up this property. They're in this deal $10 million on a $20 million deal. They're going to be in this 50%. That's a huge entry fee. I'm surprised. Pace Morby usually wants to keep his entry fee down, but this must be such a great deal. It must make so much money, and he must think that he can get such a good value add over time, over the next few years, that it's worth bringing that much money. That's crazy to me.
So how long will the renovations go? Typically on a $3 million renovation, will that take a year? Will that take 2 years?
I would say 2 to 3 years.
Yeah.
And why would it be 2 to 3 years? Is it because we're waiting for certain residents to make a determination of whether I re-up my lease in the existing model, or I say, hey, I'm moving out, which allows us to renovate that, or B, I am extending in that model, which means you can't renovate? Are those types of things something that are at play right now?
Those things matter. So an apartment that doesn't have anybody living in it is generating vacancy.
So what they're saying is rehab does not happen overnight. That's what I'm saying. These restabilizations of properties is what you call it in multifamily. That does not happen in 90 days like in residential. It happens over years. So you can't get deals with 1-year balloons or even sometimes 2-year balloons. You got to at least get a 3-year balloon, a 4-year balloon, a 5-year balloon. I don't even like balloons, man. I hate them. You guys know that. I hate these balloons. But if you're going to do a balloon, try to push out at least 4 or 5 years minimum. Try for 10, try for 20, try for 30. But you see why that it would be difficult if you're doing seller financing and in 12 months you're like, hey, you owe us all the money. Well, I haven't had time to make the property better yet. You got to give me more time. I need at least 3 years minimum, but I'm saying like 5-year balloons, guys. Don't just explain to the sellers, hey, I can come up to your price. I can work with you on the down payment. You know, if you can meet me somewhere, I can work with you on the interest rate, but I can't do a 1 or 2 or 3-year balloon. I just can't. I need time to restabilize this property. Okay, now let's just talk about occupancy, vacancy, and how that plays into effect in your underwriting.
We have very high occupancy here. In fact, we just put a news article out that the Tucson MSA, the average occupancy is in the 89%. At our property right now, today, we're 96%. And we're leased to 98%.
Which means you have tenants or residents that are moving in that will bump it up. We already have commitments that will bump it up to 98%.
Right. So the net present value
that's probably as close to 100% as you can ever get.
Pretty much, right.
Okay, thank you, Pace. Thank you, Pace. When you are going to be comping these deals, the brokers are going to give you offering memorandums or T12s and all this junk, and they're going to be like, oh, if we had 100% occupancy, this would be your cap rate. This would be your cash on cash return, your cock. No, that's not my cock. My cock is smaller because you're not going to ever have 100% occupancy. You're just not. Thank you, Pace. So when you're running these numbers, be realistic. Guys, you're not going to have 100% occupancy. You got to know the occupancy in the area for which you're doing your deals. So talk to the brokers. Look at their past occupancy and go off of that. Don't assume because you're buying a deal, the occupancy is going to be 100% or 98% or 90%. It could remain at You know, if the average is what, 89%, I think is what the really kind lady said, well, then it's use the average, right? That affects the value of the property tremendously. Tremendously. The fact that they can get occupancy up even 2% could be hundreds and hundreds of thousands of dollars on their resale price. Because again, every extra dollar they make makes their multifamily worth more. Okay, guys? Do not trust the realtors and brokers on 100% occupancy. It's not the case.
Okay, so the money, let's say I invest in the Sub-2 fund. I know we're going to do another video on why you should invest in the Sub-2 fund.
Hey, I'm not part of Sub-2. I'm not part of Gator. I met Pace Morby. He's an incredible guy. If you want to invest in Sub-2 fund, go check him out. I'm not a financial advisor. I don't know anything. All I can say is if you appreciate the videos I'm making, hey, subscribe to Pace if you aren't subscribed to Pace. I'm sure you am. But also, subscribe to me. Hey, I make videos all the time on creative finance. I'm no Pace Morby, but hey, I'm here trying to help you guys learn about creative finance, learn about investing in multifamily. So, if you appreciate the content I give to you, then subscribe and share this video with somebody else. Thank you.
And then we mitigate the expenses below by having improved systems. New windows, lower utilities, right?
Jamie, that's a really good point, and this is something I want to bring up to Pace as well. So when we're looking at value add deals, like I just said, every property is a business. So if we're able to cut expenses, that generates higher
yield,
available capital to go back to our investors. So what is something that is in the operating expenses that it's in the news, it's everywhere across the nation, everyone's being hit, especially on commercial properties, is insurance.
Insurance, man.
Right? Okay, so
getting hammered by insurance.
Right. So Jamie made a good point about how the roofs, while we did the roofs and it doesn't generate higher rent, it actually does increase the value because we're able to go to our insurance carrier and say, hey, we did the roofs, we did the new windows, we improved the actual property itself, which might not give rent, but it allows us lower insurance.
Okay, this is such an incredible point, and it is what I was talking about, right? It's all about increasing the profitability. And something I want to tell y'all who are looking at these properties for wholesaling or investing is another thing where these brokers or these sellers are going to do a little bit of white lies is on the expenses. Never trust their expenses. So let's just say you have a $1 million property and they say they have $100,000 in annual rent. Okay. And then they say they have $15,000 in expenses. So that means they have $85,000 in, net operating income. Right now I'm calling BS. There's no way your expense ratio is only 15%. Usually your expense ratio is 30, 40%. To be conservative, I like to use 50%. So something I do is I take the rents. If the rent's $100,000, I say, okay, $50,000 net operating income. Then I say, okay, your cap rate is this. Your cash on cash return is this. If you want to learn all about the underwriting, I know, subscribe to the channel, but also join my free Discord where I teach you multifamily underwriting. Literally for free. I just want to JV with you. So if you send me deals, I'll teach you to underwrite them. Then you can work with me and we'll dispo them. We'll sell them to Sub-2 fund. We'll sell them to other investors around the country. But I need you to know how to underwrite. So I want to teach you that. So it's in the link down below in the description. In the description, join my Discord. But pretty much what I'm saying is never trust the expenses the brokers and the sellers give you. It's usually a lot more.
Hopefully you guys understand where the deal came from. We talked about the purchase price, what the game plan is on this. If you guys are looking to deploy capital and be a partner with us on assets like this, we've got another 21 unit. We're going to do a video about that right down the road. And what's the rate on that assumption?
Oh gosh, so that was actually a little over 5%.
Okay, perfect.
Remember how we talked about assumptions? So this is another deal that Pace has going on. I guess we'll learn about it soon. He's not sub-2ing the loan. He's not taking over the payments. He's actually assuming the debt. He's putting the debt on his credentials. He's putting the debt on his credit because he has a nice fund now. So it's really popular in multifamily to assume debt. But you heard that number? 5%. So Another great tip for y'all, and I have videos on this on my channel, is again, look for down payments under 20% in multifamily and look for interest rates under 5%. Whether you're negotiating seller financing or loan assumptions or sub-2, like look for interest rates under 5%. We talked about that balloon. Try to get that balloon to at least 5 years, maybe even 10 years, right? At least 5 years. So now you have a good framework to go off of. You say, okay, hey, the down payment needs to be less than 20%, or if it's 30, okay, but it needs to be less than 20, right? That balloon, sorry, I can't do a 3-year balloon. What about a 5? Hey, I know you wanted a 7% interest on seller financing, but I can't go over 5. So what about 3 or 4? I'm giving you guys the numbers. I'm giving you the numbers to work with. And now once you understand those numbers, you can use that to calculate your cap rate and your cash on cash return to see if they're pretty good. I'll teach you that. I have videos on that. And then you lock it up and dispo it. That's it. You guys are almost there. The listing, this deal came from a pocket listing. So start building your contacts with realtors. And that's it. Just watch more of my videos and watch more of Pace's videos. We're teaching you everything you need to know. Stop suffering from analysis paralysis. Get on the phones. Start building these contacts. Start calling. Y'all, your future is here. It's just waiting for you to grab it. Hey, yo, big shout out to Pace Morby and the whole, I guess, Sub2 Fun team. This was an awesome video. If you want me to make more videos where I do reactions live, just let me know in the comments down below. Thank you all so much. I appreciate every single one of you, and I'll see you in the next video. Bye.